showcasing Lloyd's leading underwriters by class of business, as well as selected distribution partners of Lloyd's. This is the 8th installment in the series, and previous sessions have included a variety of fascinating and thought-provoking topics. Among them have been discussions with Lloyd's CEO John Neal, InsurTech Parcels CEO Ben Hubbard on the market responses to COVID-19. We've also heard from Lloyd's Innovation Lab and the Product Innovation Facility, held an extremely popular session on U.S. property, and in our most recent edition, took an in-depth look at U.S. D&O. In today's session, we focus on E&O, a class of business that Willis Towers Watson recently referred to as, quote, arguably the most complex area of specialized insurance. Moreover, that complexity has only been compounded by the challenges posed by COVID-19. To help us understand and navigate these challenges, we have assembled an outstanding panel of experts, and we will hear their insights and outlook from both the underwriting and broking perspectives. Before we introduce our guests, we always like to take a quick survey of our audience to gain a deeper understanding of who our attendees are. Mark, could you please launch that poll question for us? Please pick the applicable box and hit submit. We do this to ensure that we keep our information and content tailored to our audiences and make sure it stays compelling and interesting. So Mark, if you would like to post the results. Okay, looks like we have a heavy weighting of retail brokers and followed a mix of underwriters, wholesale brokers, and actually a pretty good spread of representation from all manner of stakeholders. So that's good to see. We have over 200 attendees registered for today's event. So with that being done, I want to introduce our guests. Moderating our panel today is James Calvasi, co-CEO and co-founder of Paragon International Insurance Brokers Limited. James, along with Tara Falk, established Paragon in 1996 and have since built the company into a leading specialist Lloyds and international insurance brokerage. James is a director of Paragon International Holdings Limited, Paragon Brokers Bermuda, and a member of the senior management team responsible for driving and executing Paragon's business development and retention strategies. He has more than 25 years experience as a specialist professional liability broker, leading some of the most innovative insurance and risk management programs placed in the global marketplace, with a focus on law firm and design firm sectors. James served as a board member of the Unibog Global Independent Broker Network for 4 years until 2019. And earlier in his career, he was a divisional director at Willis, Faber and Dumas PLC in London. So welcome, James.
Thank you.
Our first panelist is Lloyd Fielder, who joins us from MS Amlin, where he is a principal underwriter for professional lines. Lloyd joined MS Amlin at the end of 2010 to develop a professional lines portfolio and has over 30 years experience underwriting professional lines in both London and the US. He has focused on E&O for professional service firms, listening and responding to clients' exposure needs, and working in partnership with clients and brokers to deliver first-class service, innovative risk solutions, and excellent claim resolution. MS Amlin is a leading insurer and reinsurer and part of the global top 10 insurance group MS&AD. With a 300-year record and more than 2,400 people worldwide, it delivers continuity for businesses facing the most complex and demanding risks, and their roles place them at the forefront of the specialty insurance and reinsurance market. So welcome to you, Lloyd. Our next panelist is Jonathan Mudd, who joins us from Brit Global Specialty. Jonathan began his insurance career with XL Insurance in London before moving to Brit in 2003, where he became an underwriter on the North American Professional Liability account. In 2010, Jonathan took over the management of this book when he was promoted to the position of class underwriter for North American PL. And his role further expanded in 2016 when he was promoted to the position of divisional director of professional lines at Brit. Most recently, in 2019, Jonathan accepted the role of managing director for FinPro, one of the 6 underwriting portfolios at Brit Global Specialty. He is ultimately responsible for all underwriting, reporting, and strategy for the FinPro business lines, comprised of North American professional liability, cyber and technology, healthcare, transactional liability, D&O, and financial institutions. Jonathan is a qualified associate of the Chartered Insurance Institute, was elected vice president of the Insurance Institute of London in 2011, and is also deputy chairman of the Lloyds Market Association's North American E&O Business Panel. So Jonathan, welcome to you. And our third panelist today is Brenna Westinghouse, who joins us from Beazley. Brenna is the focus group leader for Beazley's Professions PI team, offering professional liability coverage to global law firms, architects, engineering and construction firms, among others. Brenna moved to London in 2006 to specialize in global professional service firms at Marsh. With her background as a client executive and broker, she led the international professions practice in London before moving to Beazley to lead the large law firm focus group in 2017. As a Lloyd syndicate, Beazley has been underwriting specialty professional liability since it was founded in 1986 and has been a market leader for over 15 years. So Brenna, a warm welcome to you as well. I would encourage the audience to submit questions they may have via the Q&A chat feature you'll see on your screen, because we'll be having a Q&A session toward the end. And finally, before we begin, I should state that the views and opinions expressed by the panelists and moderator today represent their personal thoughts and do not necessarily reflect the official policy or position of any agency, organization, employer, or company. And with that, James, I will gladly turn it over to you.
Thank you, Pat. Brenna, Lloyd, and Jonathan, thank you for joining us today. And let's get started, shall we? I think we should start with COVID-19 and specific to E&O, its impact. And so my first question is for Brenna. How have your practice specialties weathered the pandemic so far?
Thank you, James. When we talk about COVID-19 specific to the practice specialties, we oftentimes think of them as intertwined with the recession, or at the time of being sent home, the impending recession. So within days of us being sent home back in the early days of March, there was a real focus on communication internally, externally, making sure that the technology worked. And then the focus became on the business. Within 24, 48 hours, we were sitting down to discuss, what does COVID mean for us within the E&O sector? What does the recession itself mean, and what could it mean in the next few years? And I think that any business has a recession plan that perhaps has been sitting on the shelf. It's revisited annually, and as everyone knows, for the last 10 years, it's just been sitting on that shelf, perhaps getting tweaked. And this is really the first time we had taken it off to take a really serious look as to what the implications of this new environment and what that could mean for us. I think that our focus has really been has been less so on COVID specifically, although we do think that there are peripheral exposures. Healthcare is excluded from that. We have seen a bit from the healthcare sector, but I think anyone within the professional services industry is aware that you cannot recession-proof the professional services industry. You can underwrite your way through it. So that's been our focus, to understand the challenges that our clients are facing, and manage that forthcoming risk. Our clients have been very transparent with us about the landscape with respect to personnel, business impact, and general risks. So I think that we've done our best to keep that communication as clear and open as possible so that we understand the challenges that our clients have. We've also ensured that our own communication amongst ourselves has been as clear as it possibly can be. One of the benefits of being in Lloyd's is you get to interact with brokers, with clients, with each other daily. And so we've really stepped up the sensitivity to make sure that we can speak with one another. We know what's going on. We've been very diligent about communication where we're no longer sitting next to each other, and knowing the challenges our clients are facing, how to support them, and what we can learn from them in this potentially new uncharted waters.
Thank you. Have you seen claims impacting your customer base yet, Lloyd? You're on mute still. Lloyd, you're still on mute.
Thanks, James. I think just picking up on several of the themes that Brenna has mentioned, communication is key. And I think with a lot of our customer base, they are larger firms with a very sophisticated and long-term approach to their insurer relationships. And I think what they've done is work with us to understand really the difference between the direct and the indirect losses. Starting really with the direct losses, I think probably in line with most people's expectations, there have been very few direct claims into the professional line market, with the exception maybe of the healthcare, and then if you spread out broader to the casualty lines, there's been some activity. But I think we're seeing very few at this time. Maybe a few came in early from some large engineering contractors, but I think most of those were really out of an abundance of caution, with no real clear claim fact pattern. It was really just part of the relationship, part of the communication to make us aware of some of the ways in which in the early days of the COVID challenge that people were working with their clients to understand how it would impact them. I think insurance brokers, E&O, is an area where people would expect a lot of activity to come in the near future, just based upon any gaps in coverage that insurers may have and any gaps in expectation that may have been contributed to by various stakeholders. So I think from a direct perspective, that's what we're seeing at this stage, so not an awful lot. There is obviously a possibility and a likelihood of a lag of notices as well. Most of our insurers will have a claims made policy, and so they have a period of time during that policy period to make notices. And it's clear that they are taking some time, like everybody, to have a look and see how this situation is impacting us. So the time lag is something else we will look at for notices to come in. The second type of loss that we see it is the indirect losses. And I think a point that has been discussed at some length by many people is that COVID is the current trigger for economic uncertainty and recession. Clearly, I think, as we will discuss it in some more length a bit later, for the professional lines of casualty market, the economic uncertainty is when the claims uptick occurs for us. So COVID is really just a trigger for what we're doing. It's not an insuring clause as such, and so we will see some related claims out of that, and that will come in time. An analogy that can be used is that an economic uncertainty period or recession is our Cat 5 that goes through the middle of Miami. We are expecting a lot more claims that would come in through that period, and that's our equivalent. Just thinking about some of the loss drivers that might lead to some claims and impact on our customer base, I think there's potentially less rigor on client intake and documentation in changing times, whether it be working from home or whether it just be in difficult times to generate more business for the various professional firms. Maybe already seeing some more fee disputes that crop up through our insured clients having more of a struggle to manage cash flow. So maybe that is something to look out for and see whether the E&O claims come on the back of the fee dispute. Once again, probably referring to the working from home situation, there's potentially reduced supervision and some less of an emphasis on risk management. So I think there are areas we're looking at. Increased distraction, potentially mental health issues for employees and management teams. And to a point I just made, really, maybe not enough work, but also maybe too much work, and maybe some firms dabbling in areas they're not quite as strong with. So I think they're the main areas of the potential loss driver that we may well see the indirect losses, which are those third-party losses against the professional service firms.
And Lloyd,
back to you, Jim.
How do these economic impacts of COVID-19 affect your underwriting approach?
Yeah, very much so. I think, again, if you segment the business between the large, the mid, and the small risk, starting at the small end, it's really it's a process-driven underwriting approach where you would look to try and delegate authority, and so that the underwriting toolkit to the cover holder is smaller, and so that is a more limited opportunity to change at this time. But we have been working with the cover holder to try and understand how that is impacting their book. Skipping through to the larger firms, where it's probably easier to articulate some of the way in which the underwriting approach is affected. I think if you look at underwriting, first off, there's definitely a resolute focus on differentiating insurers based on their own exposure and experience. Clearly, in this segment, no one size fits all, and it's beholden upon all of us to ensure that each client gets their opportunity to differentiate themselves. And I think we're doing that by talking to clients, asking them how they're doing, asking them what they're seeing and how it is impacting their exposure profile. So we are spending a lot of time talking to clients, understanding how COVID-19 pandemic is impacting their relationship with their clients and how they're running their business. I think what we would then try to do as underwriters is look to segment the book based on that exposure profile. And really, it's important for insurers to consider the systemic risk potential. That is an area where we would look to see whether it's just going to be the occasional unforeseen loss or whether there really is a change in the risk pattern. And we would look to try and segment the book accordingly and look at pricing adequacy. And as importantly, and again, the theme that's come up several times already, is communicate rate and program structure expectations so that there are no surprises. Another point that affects our underwriting approach is claims resolution. Maybe there are opportunities to resolve some claims to the benefit of our insurers at this time and do that quickly. Clearly, there will be challenges as well, and some judges really won't do anything until they can have face-to-face. But certainly, we're seeing a lot of opportunities to look at ways to mediate claims sooner rather than later. And then another point that we would look to say that affects our underwriting approach is looking at the relevant similarities with past economic downturns and try and make sure we understand the triggers and see where the claims will come. But more importantly, is not to make any assumptions from the last one that aren't relevant to this one. And so we'll see where those claims come this time. And on a more macro basis, it's just access to capital. At the end of the day, all insurers are servicing the capital base they have and trying to understand whether the current current economic uncertainty is going to deliver an earning or a capital event, which may well impact return expectations of 5 different classes.
Okay, thank you, Lloyd. And I think whilst we look at some of the impacts of recessions historically on increased claims activity, a question for Jonathan: in what lessons have been learned from the last recession emanating from the financial crisis a decade ago?
Thanks, James, and good morning, everyone. Yeah, it's a great question, and we spend a lot of time really trying to navigate, through our data set, what we have learned from past recessions. And no 2 recessions are ever the same. I mean, for this one, for instance, we have no idea how long and sustained it may be or how deep it may go. But what we have observed over every economic downturn or every recession is a spike in E&O loss activity. And that is both frequency and severity. When we look at the last recession, so the world financial crisis, it was very much, I think, what you call it bank-led, financial institutions-led. And that obviously skews a lot of the numbers and the loss activity that recession actually brought through to underwriters. But if you strip those out, what we observed across what I call casualty lines, so E&O, D&O, EPL, general liability, we saw a 30% spike in loss activity, essentially, which, regardless of it being an FI-led recession, that is still a significant shift in claims pattern. When you fast forward that to where we are today, and since 2007, we've had, rates tumbling, plaintiff litigation picking up, social inflation, all these different aspects. You should probably assume that this recession for E&O underwriting is going to be a lot worse than the prior one. So we're not immune to it, and we have to prepare for it, and we have to prepare for it as much as we can now. The other thing to note is it's not today. So when we looked at the financial crisis 10 or so years ago, we did not experience loss activity in 2007, which you could argue is when, I guess, subprime and the crisis started to happen. We started to get our first notifications and E&O claims the back end of 2008 and 2009. So I think you could easily argue that there's a 6 to 18 month delay in E&O born out of any kind of recession, which what that means for us is that, yes, the recession is happening here and now, but I don't really anticipate seeing any true claims activity for another probably 6 months. And again, we need to prepare now for what that might look like. And that's why we're seeing the market doing what it's doing, which I know we're coming on to.
Thank you, Jonathan. Okay, back to how we're operating here in London. What measures have you taken to ensure the highest levels of service are maintained across your business? For Brenna.
Thanks, James. I touched on it a bit earlier in the communication emphasis. I think that something that's been really important to us is making sure that we're keeping in contact with each other, with our brokers. Appointments that would traditionally take place on a daily basis in Lloyds have now moved to video appointments. So we'll have open time where brokers can reach us. I think kind of a positive and a negative of us being in this environment is we are contactable at all times, early morning, late. So it's not restricted to exactly when you might see us during broker appointment times. But I think that something that we've really done our best to do is be as accessible as we possibly can be. And a colleague of mine made a comment recently is we don't talk on the phone anymore. Everything is video chat all of a sudden. And it doesn't have to be as formal as a Zoom meeting like we're in right now, but a lot of FaceTime and get in front of people, because I think that this is a relationship. This is a business built on personal relationships, and the ability to look someone in the eye, so to speak, is quite important. And a lot of business that comes in through Lloyd's is large, complex clients and risks, and it's important to work through those. It's not as transactional from a volume perspective in a lot of areas such as these. And so we have the ability to ask questions, engage, interact with one another. So that's on a service with brokers level. But I also think it's important. I mean, I personally spend an awful lot of time on the road traveling, in dinners with clients, and that's a part that's quite critical to how we've built this relationship over time, which is missed a bit. So we do our best to make sure that we have those touch points, not just once a year, twice, 3 times a year, really how often a client values it. We don't want to just see them for the sake of seeing them. We would like if they think there's value derived from it. And it can be even more intimate than perhaps a meeting might be, in the sense that you're in someone's home, you see their cat or their child dodging across the screen. I think that it does have that, it does forge that relationship a little bit greater. But I would like to think that people have found us as accessible, if not even more accessible. It's just not necessarily in person. And it does seem like when you live where you work and you work where you live, you are working at all times. So I would like to think our responsiveness has been acceptable. Good.
Thank you, Brenna. Okay, I think we'd like to hear an E&O market update and outlook. E&O premium rates were rising before COVID-19 broke. What has been driving these increases? Question for Jonathan.
Yeah, no, thanks, James. And that's a great question. And I'm sure every underwriter will tackle it slightly differently. I mean, my take on that is, what I call the peak of the last hard market. I mean, from my perspective, I would argue is in around 2006. That is when we saw prices or ratings starting to drop. And from that point to today, it's really, well, until about 2017, it's really been kind of a downward spiral on pricing. And it is, I can't stress enough, and Lloyd mentioned earlier, it is about pricing adequacy. It's not just about receiving a rate change, which could be nothing. 10% on a poor number is still a poor number. It is about price adequacy for the product that we're selling and the risk we are underwriting. So that is what underwriters are trying to achieve in this market, is price adequacy. This kind of realization, I think, started to happen around 2017 when E&O loss activity really started to catch up with underwriters, along with these prices that have been plummeting to the floor. And suddenly there was kind of a line in the sand, and no one would pass it. And so we got to the point where 17 things started to stabilize. Some carriers exited the class of business, capacity got withdrawn, and as a result, things just steadied up a bit. 2018. That was a kind of continuation of 17. And then 2019, I would argue we really started to see some improvement in rate and better price adequacy come through our portfolio. That continued into the start of 2020. And what COVID has done is really accelerated that process. So prices were firming up in E&O because of loss activity prior to COVID. COVID is an accelerant, a necessary accelerant, because COVID is going to cause a recession and we'll have more claims as a result. So all those things wrapped together is our own E&O hard market. I think there's a lot of kind of, speculation out there that, the hurricanes and the wildfires are causing the E&O rates to harden. I mean, there is obviously capital is important, and when capital is more valuable somewhere else, it may be withdrawn from another area of insurance, and those rates go up also. But my firm belief is that E&O is driving its own hard market as a result of the loss activity that it has drawn. And if you pull up my diagram, Mark, just to demonstrate really what the cycle we've been on, which is a hard soft market cycle. And I'll try and contextualize really to the audience exactly what the insurance cycle looks like. And this is no dissimilar for property classes or for E&O classes, but this is really the cycle E&O has been on. And if you take kind of 11 o'clock where it says profit returns to be, 2002, 2003, which is I guess the world financial crisis, rates prices significantly improved and profits returned. And then by about 2006, 2007, we had a lot of capital in the market. Rates started to fall again. Competitors started to compete against one another. Rates went into free fall. Losses started to pick up. Rates softly started to rise again, as my points around 2017, 2018, and so on and so forth. So you can see this self-fulfilling prophecy we're in. And right now we're down to the bottom end of this clock, where I believe we are. And there's going to be a polling question on this in a second to really see where the audience thinks we are on this kind of clock. But I feel like we're really coming into this hard market now, but very much driven by the loss activity we have experienced in this segment as pricing has been coming down.
Thank you, Jonathan. I think this is a good opportunity for us to have our first polling question of the audience. And I would like to ask, where do you think we are in the insurance cycle? Looking at Jonathan's chart there. A market hardening. B, market stabilizing. Or is the market showing signs towards softening? Allow the audience to make its votes. I didn't hear any of the panel talking about market softening. Be interesting to hear.
No, I was just thinking, I hope I didn't lead the witness there too much, but we'll see in the results.
Okay, so we are seeing from our audience, 78%, I believe, market is hardening. Market is stabilizing, 19%. And market signs towards softening, just 3%. Okay, thank you for that, for our audience. So moving on, Lloyd's E&O insurers have extolled the virtue of underwriting accounts on their own experience and merit. Would you say this holds true today? Question for Lloyd.
Thank you, James. Yeah, I would clearly think the larger the firm, the more sophisticated the buyer, the more focus they have on the long-term relationships and the stability of underpinning their own business, that this would be something that is absolutely vital at any time. And I don't think it's something we should prioritize any greater now. So I would say that we practice what we preach about underwriting accounts on their own experience. I think each risk has its own merits, and I think it's beholden upon all of us stakeholders to get those merits to the fore. And so I think it's quite clearly that the work of all stakeholders, the client, the broker, the underwriter, to make sure that we are fundamentally differentiating one insured from another. And I think that's a clear advantage for Lloyds and the broader E&S market. It's something we can differentiate between other markets that don't allow that flexibility. I think it's a time where we encourage insureds to continue to invest in the long-term relationship. I've always been an advocate of building the relationship before you need the relationship, to ensure there's a great level of clarity and transparency in the relationship and the information that's provided. So I think some of that we need to do more now than ever before, because we're seeing, whilst most of our clients and long-term insureds are meeting with us on virtual calls like this, I think a lot of them are being challenged by their management to justify the value of the relationship and to show what it actually means to influence an underwriter to get the best possible terms for that insurance. So I think it's a key. The relationship is needed now, and I think from our standpoint as insurers, we should help support the insureds to value that relationship and certainly to manage that upwards within their own organisation. I think that, again, we've mentioned in several cases, brokers absolutely can help. The best brokers have the best access to clients and underwriting information, which helps us differentiate and provide best terms. There's no doubt that that is more important now, and is certainly being used. There's a lot more access to information, and I think insurers are building up their benchmark pricing tools to an extent that they are more flexible. They can be utilized better on a firm by firm basis. So I think there's several attributes that we need to, within the underwriting process, that we should consider at this time, and certainly making sure that each risk is clearly measured on its own merits, which is that fundamental differentiator for the Lloyds and the E&S market, and making sure that the insureds feel that their relationship is valuable and that is valued by the insurers. And that's something that we have been able to try and challenge, but it would be interesting to see how that is viewed by them. Also, it's just making sure that part of the value-added risk management initiatives that they are seeing are being communicated well to us. And in the same way, we're communicating our trend observations back to the broker and the insured, so that we can help communicate what's influencing our decisions if it's not clear in itself.
Okay, thank you, Lloyd. You referenced the importance of relationships. So how have your customers reacted to this harder market at a time when insurance buyers are under significant financial pressure themselves? Question for Brenna.
Thanks, James. I think that one of the points that was made earlier by John is that this movement has been headed in this direction for over a year now. And to Lloyd's point earlier around being as transparent with our clients as we can be, I think that those of us that saw the challenges of claims activity coming down the pike were candid with our clients. There's the saying that your friends tell you the truth and others just sort of bite their tongue until things go sideways. I think that we have felt we owe it to our clients to be as transparent as we can be. So to the extent that clients are not surprised as to what our objectives are, I think that we do tailor solutions to those clients based on what their needs are. So I think that it's not, we don't want to purport exactly what is the right fit for them. We want them to work with us, with the brokers, to say, we would rather take a higher retention, for example, or some have chosen to take a co-insurance layer or to mitigate the cost if it's an economic issue. Restructuring programs has happened much more in the last 12 months than we've seen in years for that reason. I do think that clients with less familiarity with the insurance market cycle have really relied heavily on the guidance of their brokers and what sustainability means to their insurers and why it's important. Many clients and brokers have asked from us industry trends, given the significant claims inflation and increase in severity. And also now that we are in a recession, what we might have seen in the prior recession, so they can explain the rationale behind the pricing, because to the points made earlier, there is pressure within management to justify why these changes are taking place. And so we've done our best to support that through communication, which I think the broker also does as well.
Thank you, Brenna. So Lloyds has recently announced an increase in its capacity for 2021 to £41 billion, a 13% increase. And there are a number of new insurers entering the market as well. What does this mean for London and the E&O market? Question for Lloyd.
Thanks, James. And I think an interesting parallel really between a lot of the insureds we've talked to as well as for Lloyds is that they are having, certainly a lot of our insurers are having their best years ever, which is a great credit to the way in which they've managed their business and executed on what seems to be excellent disaster recovery plans. So I think as a backdrop, there's a lot of positives at this time, which is clearly not the only story around this pandemic, and there's lots of suffering and lots of challenges for others. But certainly Lloyds has recently announced the capacity growth for 2021. And Lloyds is the biggest it's ever been, which in itself helps it to influence, have an influencing voice and really be an E&S platform to promote that form of insurance. There's very much a difference between the admitted and the E&S platforms. And I think Lloyds is there supporting that E&S platform to the hill. Interestingly, I think what is hopefully important for all stakeholders again is that Lloyds is investing more in its operational platform than ever before. It's absolutely focusing on making itself more and more effective and a more efficient platform. And I think really the last 8 months or so have been a testament to that. In that it's been very important to continue with the service standard, but behind the scenes, there's some real progress being made on making the operational platform more effective, which I think is clearly something that's going to come as the market really streamlines its focus on data and digitization and making it work better. So Lloyds will continue to evolve. It's had a lot of change over the centuries and the decades, and it will absolutely continue to evolve into hopefully a very, very effective platform that is helpful for all stakeholders to get the choice and the service they want. I think in a hardening market, Lloyds delivers on its promise of sustainability. It clearly has some of the best-in-class underwriting and claims adjusting. It takes a very active role in the co-insurance market. And I think the influence of Lloyds and the capacity that is going to be coming out of Lloyds by the various syndicates in the various lines is going to be extremely important to deliver on the needs that the clients have. Providing the solutions, as just been mentioned. This is all about the capacity being crafted and sculptured into a way that the insureds can get the solutions they need for their business as their businesses evolve. I think the growth of any capital provider is based on margin expectations. So quite clearly, in a platform as broad as Lloyds and London, is that there are some classes will have higher margin expectations, and to a point that has been mentioned several times, will have better pricing adequacy, may have, as part of that, have better rate movement. There's going to be a lot of variation between the various classes. Specific to E&O, I think from a capacity standpoint, the Lloyds market is fairly stable. There have been some changes, some ups, some downs. But at the end of the day, the capacity is growing, the influence is strong, your ability to deliver for the clients is there. And I think from an E&O standpoint, it's probably more stable than anything else.
So noting the increased capacity and new competing insurers providing options for customers, what factors will affect your underwriting outlook for 2021 and beyond for Jonathan and Brenna?
Do you want me to take that first?
Yeah, go for it. Yeah.
Okay, sure. Thanks, James. So I think that the peers that I'm sitting in this virtual room with, in addition to a lot of our other colleagues in the E&O market, we've been doing this for a long time, and I don't think that we underwrite on the basis of necessarily what everyone else is doing. I think that it's an important benchmark and sounding board to understand where the market is so that we can be malleable as we can. But I think that really what we're trying to do is create a sustainable market, because this is a long tail class, and what we want to do is make sure that what we are looking at from a what's notified tomorrow is paid in 5, 7, 10 years time, and making sure that we are understanding the complexity of our clients' risks and underwriting accordingly. I think that one of the challenges that we have at the moment is what's reflective in today's underwriting information is not necessarily the picture that we're going to see in 6, 12 months time. So really applying what we've learned over the decades that we've been writing this class of business and understanding what is to come. How do we make sure that our client is along with us, that we bring them along in that journey? Because the reason why we're making these changes is because we value the relationship enough to want to be there when the claims actually crystallize. It would be very easy to just coast in response to perhaps competition or what might be out there. But that means that, you can count on more than one hand the insurers that have seen lack of profitability and turned a blind eye and therefore aren't around to pay those claims. So I think that what we really want to do is strike that balance of remaining as profitable and sustainable in this market cycle while acknowledging there's more capacity out there. And to Lloyd's point, I don't see a downside in having more capacity in the Lloyd's market. I think it is stronger than ever. And, it does enable people to diversify their portfolios further. So I do think it is a positive, but not necessarily because we'll be competing against each other. I think we are all wanting there to be a long-term sustainable market for the clients that value the long-term partnerships.
I think just to follow on from that, I think, and that's the key, is the long-term relationship. You want long-term insureds in this class and long-term clients. It's the best way for long-term liability to work. And I think getting clients and our brokers more sustainable pricing over the long term will benefit ourselves, it will benefit our brokers and our clients ultimately. I mean, the ricochet market, we're in a market, there's always going to be hard and soft cycles. If we can somehow narrow the peaks and the troughs, I think everyone stands to benefit. And data and claims management and the information we're now looking at in a lot more detail should hopefully serve to do that, albeit we will always be at the whim of market forces, sadly.
Okay, thank you, Jonathan. And how would you say the Lloyd's E&O market differentiates itself from its competitors then? Jonathan.
I mean, there's many things we could touch on here, but I just really want to stress claims management. I mean, that for me that is the products that is what we're selling, and I can't stress that highly enough. And anyone who's seen me talk to brokers or clients, it's one of the first things I always say. It's claims, claims, claims. That is what they're buying. It's all right having wonderful underwriting, but if there's no one at the back end dealing with the claims management, the whole thing's been a fallacy essentially. So we really want to push that to the forefront of what we do. We instruct, I think, Lloyds, I believe, has a very, very strong reputation for claims management. It not only manages syndicated placements, but it brings them all together through active collaboration and makes sure ultimately the client gets their money when they need it, on time and without delay. I can't even think of good examples where Lloyds has let the client down in my example, particularly in the E&O world, where it's a highly sophisticated claims management offering. We recruit specialists, we employ third-party specialists to deal with these claims. It is so important that we give that to our clients, and I'm pleased to say I don't think we fall over ourselves too much, and I hope that remains the forefront of our proposition as Lloyds, is the promise to pay and good robust claims handling. Coupled with that, I think, is our legacy in the class. Lloyds have been writing this class of business. I mean, you could trace it back many years indeed. I mean, Brit's got legacy going back to the 1920s writing this class of business. With that comes huge amounts of data. Data is something that has been within our systems for many years. But I think, like most industries, big data, structured and unstructured, we're now able to get in there and get it out with robots and scraping tools and so on and so forth. And that is happening behind the scenes. There's big Lloyds initiatives around data management. There's big syndicate initiatives around data management. And when you put actuarial science alongside claims handling, alongside underwriting expertise, you get some really deep and useful insights, not only useful from an underwriting standpoint, but useful to feed back to our clients and hopefully bring them with us on this journey as well. Going back to my original point of relationship management and managing the cycles we go through together and staying together through those cycles.
Thank you. And Brenna, anything further to add there?
I absolutely agree with what John has said. I would also just mention security, and I say that with respect to the security of the paper and the central fund that you get when you buy with Lloyds, but actually more prominently security of knowing that we've done this for a long time. We have seen anything that our client might have seen in one instance, we've probably seen 30 times over in the history that we've been insuring in this space. And the whole purpose of insurance is to let us worry about the risk aspect, and you get on with being creative and focusing on innovation and whatever it is that makes your business tick. So to have the comfort that we're sitting behind you, I think is really a value proposition that Lloyd's has that is probably unparalleled, I would say.
Okay, thank you. So we've heard how underwriting continues to be on individual experience and merit. I think we should ask the audience if they share in that experience and view. So next polling question, please, Mark. And the question will be, to what extent would you agree that today's E&O risks are being underwritten on their own merits? A, agree, B, partly agree, or not what is being experienced? Okay, very interesting. So 11% do agree that risks are being underwritten on their own merits, but a majority of 74% say only partly agree. And not what is being experienced is 16% from the audience. Okay, something to think about for our underwriting as we go forward. Let's move on. I think that's we understand, we talked about the challenging environment, and our customers in this environment are, need to prepare budgets for their E&O renewals, and brokers need to help their clients do that budgeting and prepare them for their renewals. So I'd like to ask the question, what advice do you have for insureds today as they prepare for their renewals and to present to the Lloyd's market for their E&O covers? And Jonathan, I'll ask you that question.
Thanks. I mean, there's just 3 points really. One is start the process early. The market is very busy at the moment. There's a lot of changes going on, and there's a lot of submission activity. So the earlier start, the better, in my opinion. Be receptive to the insurers asking more questions. There is so much uncertainty out there right now. Things are changing by the day, let alone how we're trying to underwrite, which is looking into the future whilst examining what's happening in the rearview mirror. We're going to want to ask questions, and please be receptive to those questions. They will help us underwrite. It's part of our due diligence, and it will never work against you. And then finally, and it's interesting with the poll you just did, be prepared, and I guess prepare your clients for probably some kind of pricing increase. When you look at what's happened over the last 12 years, and I will stress, we continue to write each account on its own merits, but most accounts, in my opinion, particularly the accounts we see at Brit, are now on the wrong side of the pricing curve. And this is our opportunity to move those prices on their own merits to where they need to be. But most of those will need to go upwards rather than downwards to get them to decent price adequacy. So just preparing your client for that shift in behavior after 12 years of it going the opposite direction, I think would be quite sound advice and useful advice.
Okay. And are there areas of information that will be particularly helpful for insurers in 2021 and beyond? Brenna?
Yes, absolutely. I would say, as many of you have heard us in meetings in the past, the real focus on risk management. This is where it is as critical as can be to be as clear about the focus on risk management on a going forward basis. I think that having the most robust risk protocols within an organization is all well and good, but making sure that the people on the ground are as conscious of that risk. We have certainly seen an uptick in claims that could have been avoided type claims, and knowing that we're in an environment where people are working remotely, they're juggling an awful lot in one day, that the sensitivity to how you're keeping in touch with the business and how you're communicating with colleagues, I think is of the utmost importance, really reinforcing to underwriters that you have your finger on the pulse of the business and that you are making sure that you are controlling that risk as best as possible. Because to John's point, the market is moving, it's important to us to tailor those solutions to the risk specifically. So to differentiate yourselves will aid us in that discussion.
Okay. And what value do you place on the role of the broker at this time? Question for Lloyd.
Huge. There are two massive sort of focuses for us, I think, all of us at this time, and it's access and secondly expertise. Access to business is crucial for insurers. The brokers are our sole chosen access to business, so we want brokers to win business based on value. So access and distribution is a key point for us, and I think that's where the broker's role is significant. Anything the insurers can do, most times insurers will make themselves available to help win new business, to help retain business where it's appropriate. But certainly access to business is a key broker focus. And the second point for me is all about expertise. Is that somebody mentioned earlier on that the professional, I think it was the Willis Towers Watson article said that this is one of the most detailed or specialized areas of insurance. It's key that the brokers control the management of expectations of both the insured and insurer, and they can only do that with expertise. And I think experts know their client's business, and they know how to advocate for their clients, and they know how to manage the expectations of both parties. So access and expertise is right in the wheelhouse of the brokers, and it's front and center for what their role and the importance and the value that they have at this time.
Thank you, Lloyd. Okay, well, I think that finishes the questions that I had for the panel. I'd like to open it up to questions from our audience. There is a Q&A section on the screen. We have a couple of questions that have come in. I'm going to ask the first question that I see, which is in light of the negotiations that are still ongoing with Brexit, what changes are being prepared in anticipation of Brexit with your underwriting?
I think I'm happy just to take a couple of seconds on that one. It's clear that Lloyds has got a huge focus on its operational platform at the moment, and I think what Lloyds did very well is that it did avail itself of the mechanics to write the business in that way. So I think if you take that to one point, that's maybe somewhat relevant in that insurance agents and brokers have to be aware of the platforms, the regulatory requirements that are required, and that is something that will be a new way of a new something for them. With specific regard to the spikes in insurance for them, I think it's managing expectations, and did the broker manage or communicate in line with the client's expectations and the insurers. And again, I think that's a read across to everybody that in the professional service firms are the expectations of their clients made clear, managed appropriately, and so that you look at any failure to do so would drive that potential spike.
Thank you. Okay, our next question we have from the audience is, I thought it was interesting that E&O underwriters are expecting a spike in insurance agency broker E&O. What's driving that? Have you seen claims being filed? Jonathan? Brenna?
Yeah, no, I can address it to the extent I can. So we don't write a whole amount of insurance agent E&O currently. However, I you know, when you're reading in the press and the small amount that we do, I guess our fears of what is going on in the broader landscape, and when we do see, again, looking at the trends over the past, I guess, downturns, when we have seen hard markets come into underwriting, that is when we have seen spikes in insurance agents E&O loss activity, usually because insurers restrict coverage. Take a look at what's going on with communicable disease exclusions and other types of exclusions that are going right now. These need to be very well, I guess, defined and explained to your client. When they're not, that is when your client may bring an insurance agent claim against you. I think that's the easiest way to sum it up, and that is what is happening right now. And you've also got the bigger issue around the property market and how BI has been managed. Again, that is a huge issue that obviously we're dealing with in London through the FCA, and there's a lot of, and the similar sort of thing is happening out in the US. Again, when clients can't collect their claims as they thought they would, they will bring a claim against their insurance broker or agent. And so again, whether it's a function of COVID, whether it's a function of a hard market returning, anything fundamental that's changing that is restricting coverage or finding it harder for clients to bring claims could tantamount to claims against insurance agents, E&O. Whether we're actually experiencing a spike, I don't know, because we don't write enough of it, but that is what I understand the broader market view is.
I would agree with that. And I think just to tag on to that point, John, with the advice that's being given and how difficult it has been to navigate that advice, even just as an observer, as to what is covered, what's not covered. I think that these policies that we provide to our insureds are so broad that the allegations of these issues are covered to the point of resolution, and in a downturn compounded by COVID, we're expecting the finger pointing exercises. So not to say that the agents and the brokers have necessarily done something wrong, but we have started to hear rumblings of well, I thought this was covered, this should have been covered. And there certainly has been an uptick in those kinds of notifications.
Thank you, Brenna. Well, I think we have time for one more question. That is, with a focus on robust risk management being a key differentiator for insureds, what assistance do the underwriters offer their clients to achieve excellence in this area? Lloyd, do you want to kick off?
Yeah, I would, and I think it's personally, I've always felt it is somewhere that is an area that insurers have got lots of room for improvement. I think we're quite often asked for trend observation, but as I say, there's not a lot of frequency of the same types of losses in our business, so it is harder to put these into sort of segments that would help in that area. I think one of the areas that brokers do phenomenally well is availing the services of risk management consultants who probably see a lot more of the positive approach to how to manage and prevent rather than cure the claim. So I think insurers need to provide more. Some are better than others. Some have better access to data, they're converting it into more helpful information. But I think it's an area to grow. But I think in partnership with the broker and the risk management consultants, there is a lot out there for people to share. And I think it's just trying to channel that energy, if you like, into some priorities and make sure that it's meeting the client's needs.
Brenna?
I agree with that. I would also say that a lot of the sophisticated clients that purchase insurance through Lloyds, they have the appropriate risk management protocols that we would affirm are exceptional. It's really a matter of ensuring that the individuals within those organizations are carrying them out to the letter of the law, because I think what may be in practice isn't necessarily followed as what's in black and white, and remembering how important it is to memorialize and document, and doing those things that if you were to sit down to take a pop quiz from a risk perspective, you know what the right answer is, but it's not always the way that things are carried out, because that's more often where we see issues arise, is they know what should have been done, but in that moment, that's not actually what was executed. And we see many claims and circumstances arise from issues related to that.
Jonathan, any final comments?
I mean, I would just add, I would echo what the other said. I think we can do a lot more in this arena. I think, a lot of our insureds do a great job themselves, and we want to go on that journey with them. And we have a lot of data we can add to their risk management best practice and protocols. And again, I think we're in a very good place going forward now, really being able to capture that data in a lot more usable format and hopefully play that back to our clients. I think we've done a good job at it to date, but I think we can continue to go on that journey. And with what is going on in the data world right now, we've got access to so much more, and I think that is going to present a big opportunity for Lloyd's clients to really get a deeper insight and hopefully help manage risk.
Well, Jonathan, Lloyd, and Brenna, thank you for your taking part today. Your answers have been most helpful. I'm going to pass over to Pat Talley to wrap up.
Thank you, James. Well, and there you have it. Many thanks to James and the panel today for such an engaging and thought-provoking session. It's clear to me we could have continued for much longer as we had several other questions in the queue. I think that just attests to the interest in this subject. And let me thank you, the audience, for joining today. We know there are many things competing for your attention, so we will commit to making these sessions as informative and interesting as possible. So that will do it for today's edition of Tuesdays with Lloyds. Please be sure to join our session next Tuesday, December 8th, when our panel will cover the U.S. construction market. And finally, we'll close by today asking that you please complete the brief survey that will pop up as we close out. We value your input and we will use that information to shape future programming. So thank you again for joining us and have a great rest of your week.
Thank you.
Thank you.
Thank you.